Hey agents, Evan here with another Tactical Tuesday. Today we're going to go over an event that swamped the news, that is the debt ceiling, and specifically how it impacts real estate. And then at the end we're going to touch on the 40-year mortgage and if it's even real. Looking at the debt ceiling, first we're going to go over what is it. Number two, how does it impact real estate? Number three, what are the odds that it's really going to negatively impact us? What is the debt ceiling? Think of it this way. The debt ceiling is kind of like the United States government's credit limit. We essentially say, hey, here's our budget that we have. We can't quite cover everything with the income we have coming in, so we need to issue debt to cover the rest. And that allows the government to essentially rack up a credit bill, rack up a debt level to a certain mark. But then, as personal lives, we hit a credit limit, they have to raise it to continue to go on. Right now, the United States government's debt level is here, and the credit limit is here. So now all of a sudden, for us to go any further, we need to raise it. If it doesn't, now all of a sudden we're in part number two. What does that mean for us? Well, if we don't raise that limit and we don't happen to drastically cut our spending so that we don't have to continue to issue new debt to cover our obligations, because if we cut our spending dramatically, we could be okay, but we know that's not going to happen. So what all of a sudden starts to occur is now all of a sudden our expenses drastically increase our debt ceiling, and now we could potentially go into default. Think of it this way. What happens to us as individuals or to folks that all of a sudden can't make their payments? They start racking it up on credit cards, just like we have with the debt ceiling on our credit limit. But then all of a sudden, once you've reached that limit and your Amex is maxed out, and all of a sudden you can't keep taking out more money to go pay for stuff, what occurs? People start looking and going, oh, hey, your credit just starts getting dinged, right? So all of a sudden your credit gets dinged. You have missed payments. What's that mean for you? It costs more for you to go borrow money. What's the next stage? You might have to short sale your home, as us in real estate understand, people getting pinches. You might have to foreclose. Worst case, bankruptcy. That is where, when you heard the term on the news, the United States defaulting on its payments, essentially saying, hey, our debt limit is reached. We now can't pay you back other countries who lent us money, or the biggest lenders to the U.S. are buying of our own debt obligation is ourselves. Social Security, pension funds. All of a sudden, hey guys, we can't pay you back. So what happens? Oh, hey, we want to borrow some more. Well, yeah, you've got to pay me a lot more to do it. So all of a sudden the interest rate increases. What does that look like really for the government though? The government issues what are called treasuries to raise money to pay for their obligations. And if you've heard of Treasury, because you've probably heard of the Treasury yield recently because it's driven heavily by the Federal Reserve. The Federal Reserve has been raising rates and it's pushed Treasury yields up. So you probably know maybe some of that. That was more by choice, the Federal Reserve raising rates. Well, if the U.S. defaults, it's not much by choice. Other people are going to start setting that rate a little more so. So that Treasury rate goes up. Well, what's that really mean for us? Think of it the same way as how the Fed increasing rates has impacted mortgage rates. That could drastically increase our mortgage rates. Why? If a lot of you and I have had individual conversations and we would ask me, hey, where are rates going? I tell you, watch the 10-year Treasury yield. That's the cost the government has to borrow money. And when it's here and doing this, the mortgage rates are typically doing a dance right with it, just right along the way, just a point or two higher than that. Why? Because Treasury yields are seen as a risk-free investment. Ironically, if we default, not very risk-free. Housing seen as right above that, and they go together. And also lenders use treasuries to hedge their risks, etc., and they're just tied really well together. So general consensus is if we default, treasury rates spike. What does that most likely mean? Mortgage rates, could spike dramatically as well. CNN, CNBC, a couple other news sources all estimate mortgage rates, if we default, could be up at the 8% or higher range. Now, before you freak out though, what are the odds of that actually occurring? We have had 74 rate hikes in about a 50-year period that I'm looking at here on a little notes that we had found. 1962 to 2011, 74 times, and there have been more after that and some before that too. So it's very common, and we've never defaulted. Odds, very low. The last 20, 30 years, though, these talks have been politicized a bit, and both parties are guilty of it, where now they'll go to the last hour to try to get something out of the other party, agreeing to raise the ceiling. That's where it's gotten kind of dangerous and pushed to the last minute. So we just hope that we never actually tip over on that. But what does it mean, even if we do pass the debt ceiling, what does it mean for the next few weeks or so until we actually come to an agreement? Well, it means more volatility, questions from clients, so hopefully this helps you give them some answers. We could potentially see some of the risk being priced into mortgage rates. I mean, they could be slightly elevated, but maybe not too. So it's just something we got to be aware of. If it all gets cleared out, good news is we won't have any of those issues. We'll probably just have another one. Last thing we wanted to hit on, that 40-year mortgage. Is it real? No, with an asterisk mark. What happened was the Housing Administration essentially said, hey, if you have an FHA loan, you're struggling to make your payments, we're willing to modify your loan to a 40-year amortization table, meaning you can pay it over 40 years, and that reduces your payment. That was taken completely out of context in some places and thrown out there as though there's just common 40-year mortgages that people can ultimately get. Not the case. If you have someone that's FHA that's struggling like that, then hey, they might have the chance of modifying their loan. That's wonderful. Now, there might be some random loan products out there that are 40-year mortgages, but in the general context, conforming conventional loans, not a deal yet. Hey, we should just be happy though with the 30-year mortgage, because rarely anywhere else in the world even has that. Most everyone's 15 or 20 years. So good for us. That helps us continue to grow. Hope this helped you help win, close, and list more deals. I'm Evan. Talk to you later. Bye.